Finance and Accounting Tutorials. My name is Peter and I will be your host in this particular tutorial. Today, I want us to look at cost of capital. Cost of capital, or what we call the cost of finance, is the price a company pays to obtain and retain finance for its operations. What do you mean by this? If, for example, a company wants to obtain more capital by issuing more shares, when they issue more shares, for example, they need to do some marketing, they need to do some advertisement. The cost associated with issuing new shares is a cost of finance for obtaining that capital. If they are obtaining capital by borrowing, maybe they are getting loans from financial institutions, the interest payable on those loans is a cost on obtaining that given finance. There are various methods or models of computing the cost of capital. We have the Gaudens model, or what we call the dividend yield model. We also have the risk-adjusted discounting rate, the market model, or the investor's expected yield, and the capital asset pricing model, or at times they call it CAPM. In this tutorial, I'm going to look at the first model of determining the cost of capital, and that is the dividend yield, or what we are referring to as the Gaudens Model. And this model is very useful in determining the cost of various capital components. And these capital components in particular, they include the cost of equity, which is represented by KE. Equity, the cost of equity here refers to the cost of obtaining capital by issuing ordinary shares. We have two, cost of perpetual preferential capital, which is represented by KP, which refers to the costs of obtaining capital by issuing preference shares. And lastly, the cost of perpetual debentures, which is the cost of obtaining finance through debts or through borrowing, which is normally represented by KD, presenting the cost of debt. To obtain the cost of equity, which is represented by KE, we have two formulas, and these formulas vary because of the growth in dividends. If there is no growth, then the formula that is used to obtain the cost of equity is D0 divided by P0. But in the case where there is growth, then the formula changes to KE is given by D0 into 1 plus G divided by P0, and then you add G. Please note that the G is added after getting the solution on this side. The KE here represents the cost of equity. D0 represents the dividend per share, that is the DPS, that is the dividend paid for every share. So if we have 100 shares and the dividends that were paid are 1,000, then it means the dividend per share equals the total amount of dividends divided by the number of shares, which is 1,000 divided by 100, and that would be 10 shillings, or it will be 10 shillings for a dividend per every share. Then we have the P0, which represents the current market price per share, the MPS. This represents the market price, the current, how much is that given share selling at the market, selling in the market at the current time. Then the G in the second formula represents the growth rate. So if you are told that the dividends grow at 5% rate, then G there will be 5%. To get the cost of perpetual preference shares, which is represented by P naught, is given by dP divided by pp. At times they use d naught like we have in this formula here, but just to differentiate between the cost of ordinary shares, that is the cost of equity, and the cost of preferential capital, let's use dP and pp. So the KP here, we have already said that it represents the cost of preference shares. Then the DP represents the preference dividend per share. That is the dividend payable to every preference share. Just like we have the dividend per share, that is on ordinary shares, we have also the dividend per share on perpetual preference shares. That's why we're referring to it as preference dividend per share. Then PP represents the market price of a preference share. That is the price at which a share is selling in the market at the current time. The cost of debt, which is represented by KD, is given by two different formulas. That is, if there is a maturity period given, or when there is no maturity period given, and the time when there is a maturity period given. What we mean by this is that if a dividend is issued, and we say, for example, if we have 10% dividend, that is 10%, maybe 100,000 dividend that is issued for that is valid for 3 years, then 3 years here is the maturity for that particular dividend. So it simply means that after 3 years, the company is supposed to repay back the amount they borrowed from the public, that is through issuing dividends. So the 3 years is what is making the difference between the two formulas. So in this formula, the first case, cost of debt is given by interest divided by VD in bracket 1 minus T. And in the second formula here, the cost of debt is given by interest into 1 minus T. You add that to M minus VD multiplied by, kindly note that this is not power, it is multiplied by 1 over n, or in bracket 1 over n divided by m plus vd. Again, this is not a power, this is times 1 over 2. It is in bracket 1 over 2. Now, from the formulas, the KD, like we have said, represents the cost of debt. T here represents the corporation tax, and in Kenya, the corporation tax, or in any other country, corporation tax is given at the rate of 30%. Then we have VD, which represents the current market value of a debenture. That is the value at which that debenture is selling in the market currently. Then interest, we have already mentioned, the interest here represents the interest on that debenture. For example, if it is a 10% debenture and maybe the debenture value is 100,000, then the interest there will be 10% of 100,000, which is 10,000 shillings. Then, of course, here we have M, which represents the maturity value. And the maturity value is normally the par value, unless it is issued at a discount. Now, in this case, if we issue 10% debentures worth 100,000, then the 100,000 is the par value, or the maturity value also of that particular debenture. N represents the number of years to maturity. So if, for example, here it is a 10%, 100,000, 3 years debenture, then the 3 years represents the number of years to maturity, and that is what is bringing up the difference in the formulas. After knowing how to get the various cost components, that is the cost of finance components, that is the cost of equity, cost of debt, and cost of perpetual preference shares, we use that concept to obtain the weighted average cost of capital, which is put as WACC. WACC is the overall or composite cost of capital, And what do we mean by overall composite? It entails, or it puts together the various costs on the various components. That is, put together the cost of debt, added to cost of equity, then added to the cost of maybe the cost of perpetual preference shares to give us the total cost, which is the weighted average cost of capital. In this case, to get the weighted average cost of capital, we use this formula here, whereby WACC is given by the cost of equity into bracket E over V plus KP into P over V plus KD into 1 minus T multiplied by D divided by V, whereby KE, KP, and KD in the formula represents the cost of equity, cost of preference shares, and cost of debt. E, the E in the formula represents the market value of equity, the market value of equity. P represents the market value of preferential capital, and D represents the market value of debt capital. Lastly, the V here represents the total market value of the firm, which is given by adding E plus P plus D. So you add these three components here, or the three market values, to get the V, which is the market value of that given firm. Let's look at an illustration. This is going to help us understand the concept behind cost of finance or cost of capital. And in this illustration, they're saying that the following is the capital structure of XYZ Limited as at 31st December 2002. Then you are given the various capital components. Ordinary share capital of shillings 10 per value that help them raise a total of 400. This figure is given in million, so this is 400 million. Then 10% preferential capital that was sold at 20 shillings per value, helping them raise a total of 100 million. Then 12% debentures, which were sold at 100 shillings per value, which enabled them raise 200 shillings, giving them a total of 700 million shillings. Required. You have some additional information here. The corporate tax rate is 30%, so 30% is our tax, so that is our T. Preference shares were issued 10 years ago and are still selling at par value. So MPS equals to par value. That is the market price per share of the preference shares. This is what we refer to as P is the same as the par value, whereby preference shares were selling at 20 shillings, and even today they are still selling at 20 shillings because we are told they are selling at par value. So it means a share is selling at 20 shillings now. So our PP here is 20 shillings. Sorry for that. You're also told that the debenture has a 10-year maturity period and it is currently selling at 90 shillings in the market. So the debenture are maturing at 10, they have a 10-year maturity period. They are maturing after 10 years. So the 10 here will represent our N. Then it is currently selling at 90 shillings in the market. So the current market price for a debenture, which is represented by VD, is 90 shillings. Part 4, currently the firm has been paying dividend per share of 5 shillings. So if they are paying a dividend of 5 shillings, dividend is normally paid on ordinary shares, and therefore the dividend here represents what? The D naught in obtaining, that is the dividend per share on ordinary shares. Then the dividend per share, the DPS, is expected to grow at 5% per annum in future. So the dividend here is growing at the rate of 5%, and we therefore have a G, that is the growth rate per per dividend. The current market price per dividend is 40 shillings. So that simply tells us that currently ordinary shares are selling at 40 shillings, and this represents our P naught in obtaining the cost of equity. Required: determine the weighted average cost of capital or work of the firm. So having learned or having looked at the various capital components and known the various items that we need, it's time now to go to the solution. So for us to obtain the solution, we are going to divide it into several steps, and in step number 1, you're supposed to compute the cost of each capital component. First, let's compute the cost of equity. And we say that cost of equity is given by two formulas, whereby the first one is P naught equals to, so the first formula of obtaining the cost of equity was given by D naught divided by P naught, and then the second formula was D naught into 1 plus G divided by P naught plus G. This is when there is zero growth, this is when there is constant growth. In our case, we have some growth of 5%, and therefore we are going to use the second formula. So based on the second formula, cost of equity is given by D naught into 1 plus G divided by P naught added to G. So in this case, our D naught, the dividend per share, was coming to 5 shillings. The P naught, that is the current price, the current market price, it was coming to 5 shillings, and the growth rate is 5%. So in this case, we replace this to our formula, and you obtain, remember the G here is outside, so you add it separately here, so that you get 0.18125. One thing to note is that costs are normally represented in percentages, and therefore after calculating, always ensure that you represent the cost in percentage. So you multiply this by 100 in order for you to make it a percentage. This becomes 18.13%, and that is our cost of equity. The cost of perpetual preferential capital, we saw that the cost of preference shares is given by PP divided by the DP divided by PP, whereby DP is the dividend per perpetual preference share divided by the current market price of each preference share, which is given by PP. So in this case, we saw that the preference shares are still selling at par. And at par means they are still selling at the same price at which they were issued. They were issued at 20 shillings and they're still selling at 20 shillings. So the market price is the same as the par value, which is 20 shillings. Then the dividend per preference share is 10% of 20 shillings, which will give us 2 shillings. Then replacing that in the formula, you obtain a cost of perpetual preference shares to be 10%. Cost of debentures, that is the cost of debt. In this case, we are told that the debentures which were issued have a maturity of 10 years, therefore our N is 10 years. The interest on debentures, the debentures are 12% debentures, 12% debentures, and they were issued at a par value of 100, therefore the interest is 12% of 100, which is 12 shillings. Then the maturity value is the value at which they were issued at, whereby in this case they were issued at 100 shillings, so that giving us 100 as our M, or the maturity value. Then the current market value is the value at which they are selling in the market currently, which is our our VD, 90 shillings. The tax is 30%. Replacing that in our formula, this is what we have. interest into 1 minus t by that plus m minus vd multiplied by 1 over n, then divide this by m plus vd multiplied by 1 over 2. So when you replace that in the formula, remember this is multiplication, you multiply by that, you multiply by that. It is not a power, kindly it's not a power. Then when you get the solution here, don't forget to multiply it by 100 in order to represent it in percentage, and that will give us a cost of debt as 10%. Now, having obtained the various costs of various capital components, you now go to step 2, where you compute the market value of each capital component. And the market value of equity is given by the market price per share multiplied by the number of ordinary shares. Market price per share, we already obtained that currently each ordinary share is selling at 40 shillings. This is our MPS. To know the number of shares that were traded, just get back to the number, the total value that was raised in issuing the shares. So if you look at the ordinary shares, they raised 400 million and each share was sold at 10 shillings. So to know the number of shares, you divide the 400 by 10 in order to get 40 million shares. So number of shares will be 400 divided by 10. These figures are million, so you get 1600 millions. Then the market value of preferential capital, again remember each share is selling at par, that is 20 shillings, and that will tell us that the total market value would be 20 multiplied by the value, that will be the total amount that was raised. If you look at that, they raised a total of 100 million. That is, they raised 100 million, and they were sold at 20 shillings. So 100 divided by 20, you get that as what? As 5. So it means that the number of preference shares were 5 million. We have 5 million preference shares. So 5 million preference shares, then you multiply that by the current value, that is 20 shillings, you get, so this will be 20 multiplied by 5 million to give us 100 million. The market value of debt again will be the same, the current value in the market, which is the VD multiplied by the number of debentures. So the number will be the amount of money raised, which is 200 million, divided by the price of each debenture to know the number of debentures, and then you multiply that by the current market value, which is 90 shillings, to give us 180 million. Then remember, from the formula, to get our V, which is the total market value, you add all the three components. So that will be 600 added to 100 added to 180. So when you add these three, they'll give you 100, that is 1,880. And kindly remember that this figure is in millions. So having gotten the total market value and the market values of various capital components, we move to step 3. In step 3 is where we are going to calculate the weighted average cost of capital, and here we are going to apply the formula that we looked at previously, whereby weighted average of capital is given by this formula. Now, in the formula here, we already got our KE as 18.13%, that is the cost of equity. Our cost of preference shares was 10%, and the cost of debt was 10%. Apart from that, we also found that the cost, the market value of equity was 1,600 million. Then the market value of preference shares was 100 million. Then also the market value of debentures was 180 million. Then the total, which is our V, was 1880. You replace that in the formula and you're able to obtain a total of 0.169193. Then remember, costs are expressed in percentage, so multiply that by 100 to get 16.92%. So the 16.92 is our weighted average cost of capital. You can also obtain the cost of capital by using an alternative method, which we are calling the percentage of method. That is, after obtaining the various capital components costs, you can combine them using the percentage method. How do you do this? Work is given by the total monetary cost divided by the total market value. The total market value, we have already obtained these as 1,880,000. That is, you take the P plus P plus E plus D to give us 1880. So we already have the total market value. So what we are looking at is the total monetary cost. Now, how do you get the total monetary cost? You take the monetary cost of each and every capital component, which is given by the percentage cost of that component multiplied by the market value of the capital. That will give us the monetary cost. The monetary cost of equity is given by the cost of equity, which was 18.13%, multiplied by the market value of equity, which was 1,600 million. That will give us 290.08. The same way, you calculate that of monetary cost of perpetual preference shares as 10% of 100, which is 10. Then you add them up to get 318. So 318 here is the total monetary cost. To obtain our weighted average cost of capital, you take the total monetary cost, you divide that by the total market value, which will give us 16.92. That is after multiplying by 100 to make it a percentage. So as you can see, from both formulas, we are getting the same solution. So you can simply apply the two to get the cost or the weighted average cost of capital. So that is how you get the weighted average of capital. Thank you very much for taking your time.